Hello, I'm James Jack, the head of the Business Owners Client segment here at UBS. And today we're going to dive into the one big, beautiful bill and what it means for business owners, especially those who are thinking about exiting or monetizing their life's work in the months ahead. Joining me today are the authors of two very recent UBS reports. We have Jacqueline Denton, who's the Executive Director and Senior Wealth Strategist from our Advanced Planning Group, and Paul Shao, Executive Director and Asset Allocation Specialist from our Chief Investment Office. Good morning to both of you. Thank you so much for being here.
Good morning. Thanks for having us.
Thanks for having us.
Jacqueline, you wrote UBS's really, really excellent overview of the One Big Beautiful Bill, or the OBBB for short. So before we get into the exit planning implications, why don't you just give us a very high level of some of the key aspects and updates that do impact business owners in their everyday business life?
Sure. So a lot of what the bill really did on the tax front was to make permanent a lot of the deductions that we've had in place since 2018 that were set to expire this year. So one of those in particular that's really beneficial for business owners is what's known as the qualified business income deduction. You'll also hear this referred to sometimes as a Section 199A deduction. But what this does is allow business owners to deduct 20% of their qualified business income. Now, this applies to pass-through entities. So think sole proprietorships, S corps, LLCs, anyone that has to pick up the income from the business on their personal return. So when this was initially passed, the goal was to even the playing field because C corps are taxed at a rate of 21% versus individuals that have a highest effective rate of 37%. So the goal was to get everyone to a closer effective tax rate here. So that is now permanent and can be used going forward. And another good deduction that is in the bill is what's known as special or bonus depreciation. So what this does is allows qualified business owners to take a deduction for certain equipment purchased. So like machinery, equipment, things like that for their trade or business, they can elect special depreciation and actually take 100% depreciation of the cost in the year that they purchased the equipment. Prior to the act, they were limited to 40% deduction for 2025.
Nice. All right. So let's start easing in onto the kind of the exit planning implications. Maybe what we start though with qualified small business stock, which, when I was looking at the original kind of drafts of the bill, this really wasn't talked about. So I don't know if it snuck in at the end or if it just didn't make it for the media, but there's some pretty significant changes. And for those who are maybe less familiar with QSBS or qualified small business stock, it allows for certain shareholders, mostly of C corps. There's a few requirements. I don't think we'll get into the specifics of the requirements because that's a whole nother hour. And that hasn't changed, I don't think. But it allows for some shareholders of those companies to exclude capital gains on the sale of stock of that qualified small business stock. But the amount has increased and some of the rules have been made a bit easier for folks. So tell us a little bit about that.
Yeah, that's right. So for certain owners of C corps, under the old rules, they could exclude capital gains the greater of 10% of their 10 times their basis or $10 million for stock that they've held for at least 5 years. So, and for purposes of qualifying, the company had to have 50 million or less in gross assets at the time the stock was issued. So under the new rules, under the act, the QSBS exclusion is expanded. So for the gross asset test, that's increased from 50 million of assets to 75 million of assets when the stock is issued. And then the exclusion is increased from $10 million to $15 million. So now a shareholder can potentially exclude the greater of 10 times their basis or $15 million of capital gains on a sale. That $75 million gross asset test, as well as the $15 million exclusion amount, will be indexed for inflation starting next year as well. So those will continue to tick up. The other thing that the act changed is the holding period requirement. So under the prior rules, you had to hold the stock for at least 5 years in order to benefit from the exclusion. Now there's a tiered system. So for stock that's held for at least 3 years, you can get the benefit of 50% of the exclusion. If you've held it for 4 years, it's 75%. And then 5 years or longer, then you get the full 100% benefit of the exclusion.
I mean, that's a really big impact, and we're not even talking about the benefits of stacking and things like that, which would further increase that. Again, that's a whole nother webinar. But I think the fact that also going from 50 to 75 million in assets gives a lot more startups a bit more time before they decide to issue. So there's some really interesting strategies. But one thing that is important to know, Jacqueline, I think, is this is on a go-forward basis, right? So it's not on existing stock. Can you clarify that?
Yes, that's absolutely right. So this is for stock issued after the bill was passed. So any stock issued after July 4th of this year, these new rules would apply. So for any existing companies where the stock's already been issued prior to the bill passage, they are still under the old regime.
Okay, so that they would only get the $10 million and must hold for 5 years. Everything new, potentially you can hold it for at least 3 years, and you get up to 15 if you get the full 5. Okay, that's really, really important, I think, for folks to know, especially as they're doing their planning. All right, so let's keep moving into the implications for business owners who are thinking about exit. A big thing that business owners do, and of course this is, I think, your life, Jacqueline, is as an advanced planner, is gift and estate tax planning, especially for business owners who are contemplating a sale. So what's changed or what hasn't changed in that?
Yeah, so the biggest change from the act is the exemption. So that was made permanent. Currently, this year, each person has an exemption from gift, estate, and GST tax of 13.99 million. That was set to sunset or expire at the end of this year and revert back to, roughly $7 million. The exemption is now 15 million per person starting in 2026. And that is permanent under the act. So starting in 2027, that will again increase for inflation, but it is permanent at a $15 million base rate. So, even for clients that have done some pre-sale planning starting next year, they'll have an opportunity for another $1 million or so worth of exemption that they can utilize. And I think really it really is important to just stress that they really, clients and business owners really have the right team in place, and they have their financial advisor, their tax and legal advisors, and all of them are coordinating together to make sure that clients are really taking advantage of everything that they can.
Yeah, I think that's a good point. You really want to build a fulsome team because, and you want to be intentional on your planning because it does take some amount of time in advance before you sign a binding letter of intent with a potential buyer to actually take advantage of many of the trust and gifting strategies that you employ. But I think for me, as someone who talks to a lot of business owners who are contemplating exit, I think the certainty now that, okay, it won't sunset at the end of this year, but also, unless there's an act of Congress, it won't sunset again in X number of years. So it does make it a lot simpler. And I think it gives a lot more business owners that feeling of certainty that, that they can take their time and they can be intentional about it. So I think those are really great. All these come together, Jacqueline, I think that are, overall, if you're a business owner contemplating an exit, there's a lot to like about, many of these rules that they've implemented. Paul, I want to bring you in here because there's another change to the tax law around qualified opportunity zones, and they were, I think, a very particular interest several years ago when the original 2017 Tax Cut and Jobs Act was passed, that offered people the ability to defer capital gains by making these investments in qualified opportunity zones. So what happened there, and maybe how does it play on business owners post-exit in their investments?
Yeah, thanks, James. Now, just a reminder, that program, as Jacqueline has pointed out, with different programs, has been extended under OBBB. So it has been extended, but there has been a couple of catches that I think business owners or any investors should be aware of. One is that There was a date of December 2026 where those deferrals will have to eventually be taxed. There is no extension to that date. That should disappoint current investors in the program. However, now with new investments, instead of a fixed date of 2026, like there was before under TCJA, the new investments will have a deferral program where you have a 10% exclusion after 5 years. There's no more of that benefit after 7 years. And then you have an added benefit if you invest in rural benefit programs within those qualified business zones. And finally, there is an exclusion capped at 30 years. So if you have an investment that's lasting for longer than 30 years from a business owner perspective, you will not have to pay taxes on those gains. So in short, I think the changes made in OBB keeps this program alive. That was supposed to sunset quite soon. It makes it permanent. There are just some catches that investors, both new and existing, should be aware of.
Yeah, I think Paul or Jacqueline, maybe I was talking to someone else and they said there's some interesting things about the opportunity zone, but there are a lot of the nits that Paul you were referring to. So make sure you talk to your tax advisor about what's going on. Number one, and number two is the new opportunity zone rules. They go into effect right away, or do they go into effect in a future date? What's the timing on that?
It should take new investments after this year. So I think starting after 2026.
Okay, great. Paul, one of the papers that you write on a quarterly basis, and you've written a special edition, is the CEO Macro Briefing book. I really love it because it takes sort of the CIO investor kind of thinking, but applies it to a business owner or CEO. So a slightly different viewpoint. Your paper about the One Big Beautiful Bill and what it all means, it takes a broader view. So, you've heard Jacqueline go through many of the key things. We didn't even talk about all of the parts that impact individuals and, regular non-business owners, but bringing it all together for CEOs and business owners, what are you seeing?
Sure. I think from a business owner perspective, the OBBB does give a lot of tax certainty, there was a lot of tax uncertainty this year with a lot of the provisions within TCJA potentially expiring. So extensions, as well as clarifications to some of the provisions that Jacqueline have already mentioned, the QBI provision, the 100 bonus depreciation. There are other things like increased 1099 threshold that I think business owners might find interesting and helpful because it does cut some red tapes, and the QOZs, which you've referred to. I think some things that business owners should also watch out for is that while SALT has been expanded, it's still limited. The carried interest provisions are a little stricter, and business losses are now made permanent. So it's not everything is a total win for business owners. That's why it's really important to know everything and really work with your financial advisor for anything tax related.
Mm-hmm. And perhaps from an economic standpoint too, Paul, do you have thoughts on what this might mean for business owners who are looking to exit in the coming months? I think if we go back to the beginning of this year, there was a lot of optimism about the M&A market for middle market business owners that we're regularly talking to. Some of that stalled a little bit with the tariff uncertainty, in the spring. Where might from an economic standpoint, you're not an investment banker, but from a macroeconomic standpoint, what are you seeing? What are you thinking?
Sure. I think on the positive side for business owners, for the investment environment, the OBBB, and then I think the reduction in tariff uncertainty does bring a lot of certainty back into the minds of business owners and markets. So plans to do capital investment and the rules around that I think are further clarified. And that's a good thing. Another good thing is that OBBB, no matter who you talk to, I think the short-term impact is a good thing, and that's certainly a good thing for the U.S. economy that is hampered now with the effect on tariffs. So you have a short-term benefit that should last for the next couple of years. That all being said, when it comes to other market variables, when we sort of model out the effects of OBBB, it does look like it will help push up interest rates in the near to medium term. And I think that's something that business owners should watch out for. So even if the Fed lowers interest rates, that's really affecting the shorter part of the curve. On the longer part of the curve, longer end, that's your 10-year, 30-year, and increases of that, well, we've gone into the news early this year, that has, the OBBB does sort of push up where we think longer term interest rates will be in the medium to longer term as a result of this bill passing. Another thing I think business owners and long-term economic actors should be aware of is that it does put the debt on a more unsustainable path. I think through the next couple of decades, I think through 2054, it does mean a 30% increase of GDP in debt that in the overall debt buildup, and adds about $500 to $600 billion of deficit spending, additional deficit spending from now until 2035. So with those things in mind, it does mean that interest rates will be a little higher. There might be, and the dollar will have a weight on it because it's now considered more of a risk asset given these debt dynamics compared to where it's before. So it is a mixed bag for business owners. There are certainly goodies to pay attention to and certainly to take advantage of working with your FAs. On the longer term, interest rates might be a bit higher. Their fiscal situation is a little less certain, and that does increase the pressure for whatever administration that will take hold in the future, whether Democratic or Republican. It does raise the pressures to change taxes in the future. So it's really important that if you're a business owner or investor, to lock in any potential gains as soon as possible.
Yeah, I think one thing we all know and love of our political spectrum is just kick the can down the road and deal with it. You know, some next generation will deal with it. Paul, Jacqueline, thank you so much. Maybe just a very quick recap from what I heard, and certainly we are only just touching the surface here. Both of you have great, amazing overviews, and of course, there's a, you know, I would particularly given a lot of the tax consequences, expect you to speak to your tax CPA advisor as well as your financial advisor. But from a business owner who is perhaps in the near term thinking of an exit in the next few months, I would stress, even though the M&A market might have been upended a little bit in the beginning of the year, now is the time to do the prep. Now's the time to get your business in order. Now's the time to talk to your financial advisor about what life will be like after a business sale. Now's the time to do a lot of the planning and trust planning work that Jacqueline mentioned, because you need to do much of that well in advance of signing a letter of intent. And you're going to need to eventually engage an investment banker most likely. So it all takes some time, and you want to be ready for when the market shifts back. Because if we go back to 2020, when everything stalled out, it turned on a dime, and the people who were able to get out quickly and showcase their great businesses were able to take advantage of the top values. So that's kind of the call to action. But the recap, if you're a startup, particularly a C Corp, which tends to be in that space, I think a great opportunity to take advantage of the new qualified small business stock going forward. Existing qualified small business stock doesn't really change. On a go-forward basis, though, you've got a little bit more flexibility and a higher value, which can then, with the magic of planning, become even more extended. But the fact that now you don't have to wait 5 years, you can wait 3 years and still take, much of that advantage. I think that's a big change. I've had a lot of companies who, 4 years and 6 months and didn't know that they could have taken advantage of it if they just waited a few more months and saved, a few $1 million of capital gains taxes. And then on the gift and estate tax exemption, we've got certainty now. You don't need to rush to get something in by the end of the year. That's number one. And number two is, again, that value has increased slightly, and it will increase with inflation over time. So it will take an act of Congress to reduce it. So there's no sunset on that. So it gives us the times and flexibility to implement that. So again, Paul, Jacqueline, thank you so very much for doing it, for doing all the research, doing all the legwork, make us all look good, make our financial advisors look good. For those who are listening in, talk to your financial advisor to get access to Paul and Jacqueline's reports, as well as the many other reports that their organizations do. They are on top of all of the news, macroeconomic, tax law, everything that impacts your wealth, and they're trying to get it out as quickly as possible. So thank you so very much, and thank you for your time.
Thank you.
Thank you.